Hi everyone. Today we're going to talk about a little bit about the mortgage qualification changes that are coming into effect in January. And before we get into the details, we'll go over some background information on how mortgages are approved. So in the past and continuing going forward, anyone with a down payment less than 20% will be required to purchase mortgage insurance. For all the mortgages that are above 20% down payment, the banks will now have to do a stress test, which basically says if the interest rate of mortgages was to increase by 2%, would the customer be able to sustain that new mortgage payment? And the purpose of this is to make sure that if rates were to increase, we don't end up in a situation like the US had back in the financial crisis a couple of years ago. So the way banks assess an ability of somebody to pay a mortgage is based on a ratio called TDS, which basically looks at your mortgage payments along with a couple of other payments related to maintaining your home, as well as other debt obligations such as a credit card, card loan, and other loans that you may have, divided by your gross annual income. And depending on the individual and the bank, a lot of people typically end up at about 40% as their maximum permitted TDS, but we'll use that as an assumption. It doesn't necessarily mean that everyone will actually have that as their permitted number. The other assumptions we'll use for this example is we'll use a purchase price of about $750,000. We will assume that you've got about $1,700 of other obligations on a monthly basis, being your utilities for the home, credit card payments, auto, and other loans. And we'll also assume the mortgage payments to be based on a 3.19% interest rate and a 25-year amortization. So the first thing we'll look at is if you were to put 20% down on the home, of the example that we just went through, you would be putting about $150,000 down, a mortgage of $600,000, and that would give you monthly payments of $2,900. With that, you would need roughly $139,000 to be able to afford that mortgage. Now, with the 2% increase to qualify the stress test, basically that pushes your monthly mortgage payments up to $3,550, and because of that, your new gross income required would move up to $159,000. Basically, what this says is people would either need to be able to put more money down up front in order to maintain the same monthly mortgage payments, or you would need to have a higher gross income to be able to sustain the increase in mortgage payments with a 2% increase in interest rates. So those are the two options, or more realistically, if obviously your income and your down payment availability is going to be held constant, it would mean that you'd need to purchase a home that's slightly less expensive than you otherwise would be able to buy. And depending on the region and the individual circumstances, this probably doesn't impact a lot of people purchasing homes. It'll impact mainly those that are purchasing a home at their limit. But if you've got equity in your current home and you're purchasing a second or third or whatever home, chances are this may not impact you. So you'll need to speak with us for a little bit more detail, or speak to your mortgage specialist to be able to get an exact understanding of how all of these numbers will tailor to your individual circumstances. All right, if you have any questions, please get in touch with us and be sure to subscribe for further updates. Thank you.